Hello everyone and welcome to our presentation, Good to Great, Improving Your Credit Score. I'm your host, Darren Ravenel from Spectrum Credit Union, and I really appreciate you joining our workshop today. We're going to be addressing one of the most important aspects of your financial health in this workshop, your credit score. We've broken it up into three sections: establishing credit and getting off on the right foot, taking your credit score from good to great, and upgrading or making adjustments to your credit score with debt consolidation and other strategies. There are a number of things to keep in mind that are going to help you maintain good financial health. One you may have already heard is that it's smart to have 3 to 6 months of emergency savings. This is meant to be a cushion if there's ever an unexpected financial downturn or if your employment situation changes. And when setting up these emergency savings, recognize that while it's an important goal, there may be times when it makes sense to dip into your savings in order to address your debts. I also want to point out that not all debt is bad debt. These two goals, saving and managing your debt, can mutually coexist. I'll talk more about that idea in a little bit. So let's talk about some of the most common ways to establish credit. For most people, the first thing they ever get is a credit card. Credit cards have a fancy term, an unsecured loan. Unlike a home or a car where the lender actually holds your item as collateral and can take it back from you if you don't pay your bills, an unsecured loan means that the lender has no way of getting their money back if you don't pay them. That's why credit cards have much higher interest rates, because lenders are basically making a bet that you will pay them back for the money they have lent you. We all want to get off on the right foot when establishing credit, but many may not know how. Well, the first thing to know is if the credit card you have is actually building your credit. The credit card needs to be attached to either your Social Security number, either as the primary account holder or as a cosigner. If your parents, family member, or a friend gives you an additional card on their account, it won't count for you. This can be like training wheels for establishing credit, because the holder of the credit card is ultimately responsible for paying what's charged on the card. The only way to actually establish a credit record is when you are the primary or the cosigner. This is why for a number of people, the first step could be to opening a secured credit card. You give the lender money, which is held against your credit card as a security deposit. In the unlikely event that you cannot pay back your credit, that money is there to help. This is an option we offer here at the credit union. Our Visa secured card provides an excellent opportunity to start, improve, or reestablish your credit history while earning interest on your secured savings account. Another option to think about is a retail credit card. Retail cards have lower limits and can be open to first-time credit card holders. Maybe a department store like Macy's or Target offers a credit card with a lower limit, which can be easier to get. But be aware, there's a difference between credit and financing. Just financing a specific purchase, like a mattress, phone, or computer, doesn't always count towards improving your credit score, because it's technically a payment plan and not an extension of credit. When you think about credit, you have to do some math first. You're basically trying to answer the question, how much money will someone be willing to lend me? Now, getting to that answer requires two important equations: the debt-to-income ratio and the credit utilization ratio. Let's use this example for the debt-to-income ratio. You're in your early 20s with $15,000 in student loans and a credit card with $3,000 in revolving credit. Revolving credit means that there's a balance on your credit card. Now that's $18,000 of debt that you owe between the two. Now your job pays you $54,000 a year. You divide what you owe by what you make, which puts you at a 30% debt-to-income ratio. Now the ideal is to keep that ratio under 35%. That's what lenders are looking at to make sure that your total credit outstanding is under that 35% in order to get more credit. It doesn't guarantee that you'll get more credit, but that's generally what they're looking for. The second equation is the credit utilization ratio. This is where you look at all the credit that's been offered to you versus your current balance. Now in this example, let's say the first credit card you have has a limit of $5,000, but your balance is only $1,000. Your second card has a limit of $5,000 as well, but you've maxed it out at $5,000. So you have $6,000 in revolving credit out of a total credit limit of $10,000. That's $6,000 divided by $10,000, and this puts you at 60%, which is really high. you're using a lot of the credit offered to you. Now, the ideal ratio is 30% or less, which is where you build your points to improve your credit score. We'll explore how you improve your credit score by having a lower utilization soon. Some other best practices when you're thinking about credit is paying your bill on time, every time. Now, luckily, there's a lot of technology to help you with this. Use alerts, auto payments, even align your payments with your cash flow. A lot of people may not know this, but you can call your lender and often negotiate the day you pay your credit card to be after you get paid. Let's say your card payment is due on the 25th, but you don't get paid until the 30th. You can request to pay on the 2nd. Don't be nervous to make that call. Ideally, you also want to pay it in full, or at least more than your minimum payment. If you're disputing a bill, still pay it before it goes to collections. Even if you're hit with a charge you think is wrong, and you call your credit card provider to put in a notification that you're disputing it, many times they may ask you to pay the bill before it goes to collections. And one of the worst things that can happen to your score is to go into collections. Another good practice is to pull your credit report to look at what's on it and what credit cards are out there. You can check it regularly at annualcreditreport.com. So, how do you improve your credit score? Does everyone know what their credit score is? I'd compare that to your height or your weight. You don't have to share what it is, but you should know what it is. And if you don't, I definitely recommend you take a look. It's easier than ever to check your score. Here at the credit union, when you use our mobile app, you can view your credit score and continue to monitor it. Just to let you know, the score is only updated monthly, so once you've gotten your information for the month, you won't need to check it again for a while. So, how do these credit bureaus calculate your credit score? There's 5 parts to a credit score. The first is your payment history. And this is why I stress how important it is to pay your bills on time. It counts for 35% of your total score. The second is your credit utilization ratio, which makes up 30%. The third, which seems counterintuitive, it's the length of your credit history. Now with this 15%, you get points for the longer you hold on to credit cards, the longer you pay off loans, even the longer you live. So, like wine, some things do improve with age. Then they want to see variety of credit. You get more points if you have a car loan, mortgage, credit card, even student loans count. And then there's potentially the opportunity to increase your score by not making hard inquiries or pings. Pinging is when people identify you to offer credit. If this happens too much, you can actually lose points. And this is why a lot of people will go into the 3 credit bureaus and ask them to make sure people don't offer them credit without consent. Speaking of the credit bureaus, there's 3 major ones out there: Experian, TransUnion, and Equifax. Now, you may have heard the branded term FICO before. Experian is the bureau that came up with that term. Each of these credit bureaus, they rate their members differently. The top score is 850 across the board, however, the way they bucket their tiers varies. As you can see, Experian has 5 buckets, while TransUnion and Equifax each have 4. This does make a difference. With a score of 700, your FICO is good, but with TransUnion, you're average. Now, if you're wondering how you stack up, the average score in the United States pre-pandemic was 703. Now that we've gone through the bureaus and score, how do we take your score from good to great? And why does it matter? Most good credit scores mean your lender thinks you're more than likely financially responsible. Ideally, you pay on time and don't carry a high debt-to-credit ratio. You seem likely to pay your debt. Great means you have a long history of paying on time and low to no revolving balance, and you've proven to be a reliable borrower long-term. Let's talk about why it matters. This is where the rubber meets the road. Oh, and by the way, these numbers are just for illustrative purposes. Rates change all the time, so we're just using these as examples. Now, let's say you want to buy a house and get a mortgage for $240,000. If you have a good credit score, they will lend it to you at 4.12%. That means your monthly payment is $1,160. If you have a great credit score, they may lend it to you at 3.87%. So your monthly payment is only $1,125. It's only a difference of $35 a month. Not a big deal, right? Not so fast. If you take that number and multiply it over 360 months, which is a 30-year loan, you are saving $12,600 in interest payments. Now that's a big difference. Where it makes another big impact is in auto lending. Here's another example. You want to buy a new car and get an auto loan for $30,000. With a good credit score, they will lend it to you at 4.54%. Over the course of a 5-year plan, you will be paying almost $3,600 in interest. Take that same $30,000 loan with a great credit score, and they could lend it to you at 2.54%. Over 5 years, your interest payments would total $1,980. You're saving over $1,600 with a great credit score. Let's talk about some sneaky ways to boost your credit score. First, we covered keeping your credit utilization under 30% and getting bonus points if you keep it under 10% or having no balance at all. Now here's an idea. Call up your credit card company and ask for a credit increase. If they agree and you get it, don't use it. This instantly changes your credit utilization ratio because you have more credit you're not using. Immediate benefits. The same thing might happen if you pay off a credit card. Here's a personal example. I recently decided to pay off a credit card and close one I didn't need. I had multiple cards with the same company, and they actually offered to take the limit on the card I wanted to close and apply it to the other card. The good news was that my credit utilization stayed the same, and I have one less card that I no longer wanted to use, plus no ding for closing the card. You may want to limit your own personal credit applications. It's compelling to apply for a credit card, especially over the holidays or when buying big ticket items, but you may want to do it only once or twice a year. Keep those cards open for at least 2 years. The bureaus look at closing it early as bad practice. Now, if you have a revolving balance, it also helps to pay your credit card more than once a month. It shows you're trying to be a responsible borrower. Finally, be patient. Excellent credit scores only really come after a long credit history. Let's get to our third part, which is debt consolidation and other strategies. What I really encourage you to do is when you go home, gather all your credit card statements and your loan statements and look for your interest rates. Believe it or not, less than 8% of people can accurately state the interest rate they're paying on their loans or credit cards. They guess. Same with their mortgage. I really encourage you to get your statements and add them to our debt worksheet. Now that you know what interest rates you're paying, if you're paying a higher interest rate than you'd like, you could try and find a low-rate card. Just be careful of transfer fees. This can buy you more time when you're not incurring extra interest. Another strategy is to pay off your debt with an unsecured personal loan. At our credit union, we offer much more reasonable loans down even into the single digits. This strategy allows you to combine all of the balances from your various credit cards into one loan with a single lower interest rate. You pay off your high interest cards with the proceeds from the loan. Now you have an installment loan where you know exactly how much you're going to pay off every month over the term of the loan, which can vary anywhere from 1 to 5 years. You traded credit card debt for the installment loan, which the bureaus see as a positive. You can usually see an improved score if you consolidate from a credit card to an unsecured loan. Another strategy is to pay off your higher credit cards first. Tackle the big ones and then work your way down. If by chance you have a high interest rate on your auto loan and you've had it for at least a year, it's probably worth looking at refinancing your auto loan to a lower rate as well. You want to make sure there's no prepayment penalties or if you've needed to keep the loan open for a certain amount of time. But just like a home loan, if interest rates drop, it can make sense to refinance. There are a few other debt consolidation strategies that work for some people. One is to ask a family member or a friend to loan you some money. They can even create a promissory note to create a more official agreement that you will pay back the money. Now, if you don't know if you're a good debt consolidation candidate, Check out the various consolidation calculators out there to help determine if consolidation can make sense for you. Then there's advanced strategies. If you own a house, it's possible to get a home equity line of credit where you can tap into your house's equity. If you have a brokerage account, some people use margin loans. These are a little more risky since you're borrowing against the assets you have. Finally, our financial education partners at Balance offer credit counseling for free. They can help you create a spending plan that allows you to take charge of your financial situation on both a month-to-month basis and in the long term. To speak with a counselor, call toll-free 1-800-777-PLAN or 7526. You can also get more Balance content through the financial guidance section on our website. Now, I know we've covered a lot, from how to establish credit through improving it to upgrading or adjusting it. Now, if there are three major takeaways from this workshop, it would be these. 1. As the primary or co-signer for a credit card, you need to know your debt-to-income ratio and your credit utilization ratio, ideally keeping both below 30%, and do your best to pay in full, on time, every time. 2. Remember the three credit bureaus: Experian, TransUnion, and Equifax, the importance of this scoring system, and how it can have a major impact on your payments. And 3, once you know your credit score, there are multiple avenues you can take to improving it. If you need help, our financial education partners at Balance offer free credit counseling. That does it for our presentation, Good to Great, Improving Your Credit Score. We hope you learned a few things to help you in your journey to financial wellness. Once again, my name is Darren Ravenel from Spectrum Credit Union. Thank you for taking the time to join me, and we hope to see you again soon.